Hi everyone and welcome. It's Steve Johnson here, Chief Investment Officer at Forager Funds, and we're doing a quarterly webinar for both of our funds today. We've decided to do this on a regular basis, so with each quarterly report we'll follow it up with a quick webinar and do a little bit less of our video and other content in between. We'll keep it short and sharp because they're going to be pretty regular. About 20 minutes of commentary from us about what's been going on in the portfolios, and then some Q&A at the end of that. I'm joined by Gareth Brown, Portfolio Manager on our International Fund. Got Alex Shevelev here as well, Portfolio Manager on our Australian Fund. Hi, guys.
Hi, everyone.
But before we kick things off, the usual general advice disclaimer: we do not take your personal circumstances into account and you should seek professional advice where possible. Today's presentation is general advice only. We're going to jump straight into things. I'll wrap things up with a few words of my own, but Gareth's going to kick things off with a summary of what's been happening in the International Shares Fund. Gareth.
Thanks, Steve. Thank you. I'll give a quick run through of our quarter and some of the new ideas in the portfolio. Steve and Alex, if you have any questions or comments, feel free to pipe up. Both the fund and our comparison index were pretty flat over the quarter, and that's after a small tailwind from a weakening Australian dollar. So in general, stock prices were down a little. Unsurprisingly, for a flat performance, we've had some winners and some losers. Once again, Motorpoint, the UK used car retailer, makes the loser list. It's clear we've made a mistake here over a longer period of time. But I guess more recently, we've been really surprised about the stock's inability to find a friend. The biggest issue the past few years has been a shortage, an insufficiency of near new inventory for them to sell. They like to sell these sort of 1 to 3 or 4 year old cars. And that's all been related to the massive fall in new car sales in the UK and indeed globally, 2020 to 2022. We think that will lift soon. Each month, data from the Society of Motor Manufacturers and Traders in the UK that compiles the relevant information for the whole country shows a strong rebound in new car sales in the UK, particularly in that fleet segment that then go on to turn their new cars and sell them relatively quickly. Those sales are not back to 2018, 2019 type levels yet, but big growth on the prior year. And that sort of recovery is almost 12 months old now. We think it bodes well for the used car market, maybe 6 to 12 months from now. But we're not seeing any of that anticipated in the Motorpoint share price. A general aphorism that we work on is in the US, investors tend to anticipate recovery and price it in. And in the UK, there's a bit more of a wait and see. I want to see it in the profit and loss statement first. That may be a truism that's holding here, and it may take some time for recovery to take hold. Another disappointment was global gambling giant Flutter. It's been a sector-wide gambling sell-off. We had significantly lightened our position prior to June, and we've used the recent weakness to top up. One thing that does come to mind here is that 12 months ago, its most important competitor in the US, DraftKings, was really quite a hapless competitor. And they seem to have really gotten their act together over the last 12 months and are providing a little bit more competition than maybe the market was expecting. It's something we're watching closely. And then the last of the list of losers for the quarter, Keysight. This is a market leader in instruments and software and systems for design and testing of electronic equipment and communications equipment. Again, it's a global leader. It's had a decent second quarter result, largely in line with what we expected, but the outlook for the third quarter was weaker, and the stock has sold off as a result of that. Offsetting these three and a handful of other smaller losers, we've had a few nice winners as well. Gulf Marine is a company that owns offshore vessels used in the oil and gas industry, particularly in the Persian Gulf. It's been a very small investment in the fund. It is a highly risky situation, lots of debt involved, and we need them to pay that debt down for us to make money. The stock almost doubled in the quarter, though, given the nice cash flow and the ability to deleverage. So we've made some good money there. Another one was Sprott Physical Uranium Trust. This is an investment effectively in physical uranium. Harvey's touched on this already in a podcast and I think a video as well, so I won't spend any time on it, but it paid off nicely for us over the quarter. But the most meaningful boost to returns has come from Blanco Technology Group, which became subject to a takeover in August, which is now in its final stages. We have really mixed emotions about this. Blanco's proven an excellent investment for us over a 6-year period, and we view the takeover, I guess, as proof that we were on the right path. But we're very disappointed in the price, and we feel that investors could have made a lot more money here with a little patience and better guidance from the board. We fought the takeover quite intensely. We made our thoughts known to anyone that would listen, but unfortunately, the block of shareholders who agreed with us ultimately was too small to change the outcome. So private equity has been able to buy this asset too cheaply because UK investors are so pessimistic at the moment. So while we might lament the outcome here, that same pessimism means that there are plenty of attractive opportunities available elsewhere on UK exchanges, and we're channeling our frustration productively to try and find new ideas. Let's move on now to new ideas. There have been several joining.
If I just jump in really quickly there, just jumping back to that performance slide, you can see down the bottom here, small cap stock performance. Yeah, every single small cap manager, every single manager in the world is complaining and whinging about the fact that the largest 7 companies out there are driving all of the index performance. So I'm sick of hearing about that. I'm sure you are too. But I think it's worth pointing out how bad small cap performance has been relative to large cap. That's driving a lot of that frustration that you're talking about, especially in the UK where it's been going on for 10 years. It's leading people to takeover bids that I don't think are fair value for the shares. But as you've said, it's also creating an environment in which there are plenty of opportunities to redeploy that capital. But just the magnitude of, you and I were touching on it this morning, but you know, we're getting takeovers in our Aussie portfolio at 70 and 80% premiums to what are fairly beaten down share prices. That UK one for Blanco was a 30% premium for what we think is a really high quality business. So it is frustrating, but I think it's reflective of what you're seeing on this chart here.
Maybe, but there are takeovers going through in the UK at the moment at 60 and 70 type premiums as well. So I feel like we got a little screwed there, but anyhow.
All right, sorry for the interruption.
On to new ideas. CRH is a world-leading materials business, particularly in heavy materials like aggregates that are used as filler in some stuff like concrete and asphalt. We've kept an eye on the whole quarry-based business sector really since reading Peter Lynch's book One Up on Wall Street. Must have been almost 30 years ago. Building materials like this, they're heavy and they don't travel well. They're very expensive to move. And so the local quarry or a handful of quarries end up with fairly significant pricing power that allows them to march up prices annually. And you don't tend to see that in a lot of other material commodities type businesses. And so CRH, really owns thousands of these local monopolies and oligopolies. And it's been a very good investment over a long period of time. Of course, these qualities aren't lost on the broader investment community. Everyone's aware of the power of these quarry-based businesses now. So what's made CRH specifically cheap? Well, this is a business that's predominantly in the US, whereas due to historical reasons, the main listings have been in Ireland and in the UK. US investors have tended to ignore it, and we've seen that elsewhere. They just don't look at things that aren't listed in the US. And so this business trades at a fairly large discount to US domestic equivalents. CRH has now moved its main listing to the US, and that created a period of flux here. So some of the European investors that have held it for years have been forced to sell because it's no longer in some European indices. And there's new US investors that have been forced to buy because it's turning up in indices in the US, but those two things didn't match up perfectly. So there's been this period of flux. So for us, this is an excellent business, but there's an element of geographical arbitrage here. And so CRH is really an investment from the same sort of playbook as our investments in Ferguson and Flutter, and even to an extent Blanco. So high quality business, but cheap for a weird market reason. Another idea that will be familiar to many of you, the the international fund and the Australian fund have taken positions in ResMed. ResMed is a dual listed business with its roots here in Australia and a listing in Australia and another listing also in the US. ResMed is the undisputed global leader in CPAP machines that are used for treating sleep apnea, and also creates a lot of recurring revenue from masks and other things that you need to buy, consumables. Look, the stock's fallen more than 30% over the past few months. You may well have read about that. The reason is mass adoption, or I guess fears of mass adoption of these GLP-1 inhibitor drugs that are used to treat obesity. People are having profound success losing weight on these drugs. Sleep apnea is strongly correlated with obesity and indeed sometimes caused by being overweight. And so the theory is that people will opt to lose weight through drug intervention and thus won't need a CPAP machine. Look, those fears are not just impacting ResMed. Everything from the manufacturers of continuous blood glucose monitors and insulin pumps, right through to food products companies and fast food companies, have been sold off over the expected changes to the market coming from the adoption of these drugs. We don't disagree that it will change the landscape and will crimp some of ResMed's growth, but we don't think it's a silver bullet either. It won't circumvent the need for treatment in a lot of cases, and the pool of undiagnosed and untreated sleep apnea sufferers globally is huge and probably still growing. So this is a contrarian bet that Mr. Market has gotten a bit too pessimistic. Look, I think it's worth noting here that there are a lot of fund managers in Australia that are also buying ResMed in the past few weeks on the exact same thesis. That would normally make me extremely uncomfortable that we're on the same side of the trade as everyone else. And I'm not going to lie, I'm still a little bit uncomfortable with that. But it is worth noting this is a dual listed business. The great bulk of trading is done in the US, and we think that's where the selling pressure is mainly coming from. Hedge funds shorting a basket of, GLP-1, negative GLP-1 players, potentially going along the drug manufacturers as well. So we think the market is still lopsided to the weight of selling, even though you may have heard from lots of fund managers here in Australia that have been buying recently. It doesn't mean we won't be wrong, but we don't think it's the consensus trade that it seems when you just look at it from a local perspective. As I pointed out, ResMed's a position in both our funds. It's a smaller position in the international fund than in the Australian fund. Look, it could go either way, but we think we're being paid adequately for the risk of more bad news here, and we think the business's underlying qualities will shine through over time.
Yeah, I'll just jump in there, Gareth. Like you said, we do own this in both funds. It was actually written up in the Aussie fund portfolio last month. We're taking these GLP-1s very, very seriously. And I think some of the commentary I've seen out there is blindly, this is not going to have any impact on the business at all. And I think this is a risk that wasn't there 2 years ago in terms of this business. And for me, that means the value that I would put on it is lower than it was 3 months ago. It's the magnitude of the movement here that we think is overdone, rather than thinking that this drug is nothing to worry about. I think they are showing some very, very interesting results, and a lot of the problems or a lot of the reasons people are saying you don't need to worry about it, like cost, I think will go away over time. Now, time is an important factor in any investment, but we're going to be watching that very closely and monitoring it closely and keeping the portfolio weightings here at sensibly conservative levels. With that, Alex, we'll talk about some other Aussie fund performances. Over to you on the Aussie fund side.
Hi, Steve. Hi, everyone. And thank you for that, Gareth. Now, apologies for the labeling on this slide, but we actually had a pretty good quarter and quite an eventful quarter for the Australian Shares Fund, over 5% of alpha relative to the index there. As you can see, the 3 and 5 year numbers are below that index, but we've included there the small ordinaries and the small industrials performance just to demonstrate it's been a very, very difficult part of the market, and we have been disproportionately involved in it. Now, onto the portfolio contributors themselves. During the quarter, we had a takeover at a very significant premium, as you heard discussed by Gareth and Steve there, on Healthier. Now, this is an allied health business operator. Think podiatry, physio, and optical. a private equity group came in and offered an 84% premium to the prior day's close. That was very healthy, and we are happy with that price. It added about 200 basis points to portfolio performance. We had a couple of good results come out of August as well. Motorcycle Holdings was one of them. On the core business of selling motorcycles, accessories, and the like, things have been going worse, as you'd expect. But they made an acquisition quite recently of a business that imports a particular brand of ATVs and quad bikes. Now, those are doing better as that brand has taken more market share due to a regulatory change and has continued to grow, really bolstering the performance there relative to some very, very low expectations. ReadyTech is another you would have seen it in the top 5 quite consistently. It's a software business across a number of verticals, and it continues to deliver. One of the things we think in this thesis is consistent delivery of some very solid results are going to result here in not just growth, but also significant re-rating. And we think ReadyTech in the last result has actually done a fair amount towards that goal. On the flip side, a negative contributor was Paragon Care. Paragon Care saw its CEO step down and a major shareholder step up. We had a couple of exits during the quarter as well. Larger stocks, predominantly Seven Group, was one that continues to be a resilient business, good capital allocator, but valuation being somewhat difficult there. Qantas, another which had record profits and a very, very favorable environment. I think you would have all seen the news around Qantas recently. We exited that during the quarter at significantly higher prices, also on valuation grounds. And Enero, which had been in the portfolio for a very long time, a small position in Enero was finally exited during the quarter as well. The performance of the agency's business has lagged. There's been issues around acquisitions made and around the US business OB Media as well. So just onto the next slide there.
Sorry, I was just muted. I'll just jump in quickly, Alex, before you move on. But that Enero, long-term investors here will know we've owned that stock for a very, very long time. It's been in the portfolio, various portfolio weightings for about 13 years. And we've watched that company go the full cycle. We bought it after its first acquisition binge went wrong. 7, 8, probably 10 years of hard work fixing that business, getting it back on a stable footing, profitable and debt-free, and then new management, new board, and the whole cycle began again. They went out and bought a bunch of businesses at crazy prices and spent all of the money, and now it's back in a troubled position again and is probably going to need a turnaround expert to come as well. So it was a very, very good thing that we were almost out of that as it all unraveled again at the end of that 13-year investment time frame. But just amazing to watch the folly, I think, is the best way of putting it, of management teams that can completely forget the history of that sector and that industry. Sorry,
thanks, Steve. Gareth's already mentioned the investment previously in ResMed. That was actually in the Australian Shares Fund first, and subsequently followed by the International Fund. Another in the portfolio, new one for the quarter, is EQT Holdings. This is a very unique business. It is the old Equity Trustees, traces its roots back to 1888. There's $160 billion of funds that are being overseen by equity trustees in their trustee and wealth services business. I say unique because it has some revenue streams, for example, that are perpetual in nature, and it has other characteristics like a bank of wills that actually provide new clients for the next couple of decades. The business has a very strong position in corporate trusteeship alongside perpetual and significant market shares in some of the other areas of trusteeship. With the acquisition of AET recently, they've bolstered that and added some synergies in combining the businesses. Now, over the next year, those synergies should become somewhat more apparent. There was a UK foray that's now been closed down, and there's just organic growth that will lead to margin expansion continuously at EQT. And 14 times is light on for a business with such significant growth and especially higher quality revenue streams. Another is Tyro. You've probably seen the Tyro logo on the payment terminals as you swipe your card at a cafe or at a restaurant. They process about 5% of the in-person Australian spend across Australia. The merchants that use Tyro are quite sticky, so about 9% of that transacted value churns every year, which is quite a low number. And it continues to win new merchants. And the dynamics in this space are that the big banks have largely not appropriately serviced those small and medium-sized customers. They have gone off to seek other payment providers and found the likes of Tyro and some of the other competitors. Now, those competitors are still competing and potentially stronger than they were a couple of years ago, but Tyro has continued to win their fair share of those ex-bank customers as well. There was a management team here prior that was keen on continuing to spend and burn cash. The new CEO and the new team has wound that back somewhat. We're now getting significant incremental drop through of revenue through to profits, and that's resulted in a business that's trading about 14 times next year's earnings when you adjust for the excess cash that is sitting there in the business. I think this is an important slide, this next one, on the opportunity in small caps in Australia at the moment. This is a graph from June of 2020 to today, and it shows the underperformance of that small ordinaries accumulation index relative to the all ordinaries by about 25%. We've seen it in our numbers. We can see it in the stocks that we look at. There's been many reasons for this. Attention for smaller companies is generally dissipated. Money's flown out of the space. Prices are lower. That generates lower liquidity, lower performance, further fund outflows, and it becomes a bit of a dangerous loop until you get to a point where some valuations, the stocks that we've spoken about, some in the portfolio and some other available opportunities, get to very significantly depressed levels. You start getting the pickup of M&A and renewed interest in the space. At the moment, we see quite a lot of businesses, smaller, higher quality, growing businesses trading at very low, particularly attractive valuations. So we're very excited about what's in the portfolio currently and very excited about the new stocks that we're finding out there as well. Back to you, Steve.
Great, thanks for that, Alex. And I think there's been a lot of, both from us and from other people as well, a lot of talk about how the index has been performing. But for me, this is just a much, much more favorable environment for our style of investing. And you've seen that across both portfolios across the course of this year. We are back in a world where interest rates are positive and are driving investment decisions in a way that, as I said in my recent CIO letter, is much, much better for financial markets than zero cost of money driving the value of everything up and throwing a lot of free money at businesses that in a lot of cases don't deserve it. You can see on this chart here that's 10-year government bond yields in Australia and the US. Here in Australia, we are back at a 10-year yield that hasn't been seen in the past decades at 2011. In the US, you've got to go back to before the financial crisis of 2007 to see bond rates and that 10-year number that were higher than where they are today. And that is important for equity markets because it's the benchmark off which everyone values other assets. So if you're sitting there looking at commercial property, for example, and it was yielding 6% and you thought that was great in a zero interest rate world, in a world where you can get 5% on your government bonds, you no longer think that 6% is the right number. So I think for overall valuation levels, that is a negative for equities, but it is also forcing businesses to operate more efficiently because there is less capital available. and it is forcing that capital to get allocated to situations that offer higher rates of return. And that zero rate environment that we had seen over the past 5 years was not good for large swathes of the market. And I think it was not good for our particular style of investing as well. There are a lot of businesses out there that depend on efficient allocation of capital for the business model to work. Again, I touched on this in the CIO letter, but there's a great, well, the book itself is not great, but a great concept outlined in a book called The Capital Cycle. You can click on the link in the quarterly report, but the whole concept there is that money flows into sectors that are over-earning in terms of return on capital. That extra capital drives down the profits the companies earn. When the profit gets below what is an acceptable rate, then no new capital goes in, and indeed capital often goes out, and therefore the returns come back up. And it can be a great way of investing, to invest in those companies that are under-earning on their assets on the assumption that capital is going to come out. It has not worked for the past 5 years because there has been so much cheap capital out there. Gareth touched on this stock earlier. This is Gulf Marine Services. They own a bunch of servicing vessels that operate in the Middle East. It's a pretty straightforward business. It's a chunk of steel that's turned into a vessel that can propel itself around and go around servicing oil wells in mostly shallow water. And it's not difficult to build these things. It's not easy to operate them, but it's not difficult to build them. And in a low interest rate world, there was capital coming into this sector that was making the return on this company's historical assets very, very, very low. What have we seen since interest rates have gone back up? Well, Gulf Marine's own cost of debt is now 10% instead of 5% where it was before. And someone who's buying a new asset is borrowing money at 10%. The cost of the asset itself has gone up 20% because of inflation, and therefore the rate that they need to charge on that asset is substantially higher than it was a year ago. In fact, we have seen one new vessel come into this whole sector over the past couple of years, and now that interest rates have risen, inflation has come through, the day rates required are still substantially higher than what Gulf Marine is currently charging. So their rates have been going up 20% per annum. The cost base is pretty fixed, and you're seeing that flow through to cash flow, and now seeing it flow through to the share price as well. There are huge parts of the market, and I actually think the whole Aussie market, being quite commodities based and quite financial sector based, has not performed as well as the US, for example, in this very low interest rate environment. And I think as capital gets allocated more efficiently, it could actually be a good thing for the profitability and the valuation of a lot of those companies. You're seeing that turn up in takeovers across both portfolios as well. This slide has one in Vienna Airport and ReadyTech, sorry, two stocks there that takeovers didn't go through. Sorry, there are three stocks down the bottom there where the takeovers didn't actually go through. But you can see a slide here full of companies that have either been taken over or have been subject to takeover approaches. Again, I think that is a function of very, very cheap stock prices out there. It is a great way for us to make money and recycle that capital back into new opportunities again. And it was a very, very common theme of the first 7 years of us running this business that became less and less common as share prices got more and more expensive. So we expect to see this to continue across both portfolios. When stock prices are really, really cheap, you see other people come along and want to buy it. I think that creates opportunities for people that are out there actively investing. I think if there's one criticism that I'd make of us over the past 12 months, it's that we're not being even more aggressive than we have been in terms of portfolio turnover. I think these are markets where if you make 40 and 50 and 60% out of a stock, it is important to move on from it and to redeploy that capital into new opportunities. But you can see on this slide that calendar year to date has been good for both funds, despite those small caps dramatically underperforming. And I don't want that small cap index performance to be an excuse for us. I think it's a very rich environment. You can buy businesses out there where you genuinely do not care what happens to the share price over the next 10 years. You're going to earn returns of 15 and 20% per annum from owning them. And our job's to get out there and find those businesses and do well for you over the long term. With that, we'll move on to Q&A. I'll just take a pause for a second and move across to the question list, and we'll jump straight into it. Alex, here's a good one you can jump straight onto. It was a bit shocked to see Tyro classified as a high-quality business in a recent update. It's been a shocker since IPO, the business and management. Is it really a business with great prospects to allocate capital? The competition seems much better. Please elaborate on the thesis.
Great question, Anon. Thank you for that. Look, Tyro has traded upwards of $4 at a particular point in time. And yes, it's been a very poor performer. It has not been in the portfolio for very long. And I think there is a danger of historical share price, in this case, from very high valuations, being tainting the actual underlying quality of the business. It is low capital intensity. It is a business that has a very low churn revenue stream, and it is a business, despite the somewhat resurgent competition, that's still winning its fair share of those leaving the major banks. So yes, I think it's fair to classify it as a higher quality business. And we think that now we're at a point where the business will be generating, which it had not historically, significant free cash flow over the next couple of years, which will hopefully cement that position in the minds of other investors.
I'd just add to that, Alex, I think blindingly obvious high quality businesses are very rarely great investment opportunities. That's probably been questioned over the past 10 years because there's been this massive tailwind behind quality as a factor, but the opportunity is really finding quality where other people are not perceiving it. And we've done a lot of work on this business. I think the new competition is worth touching on because they are a threat. You've got Squares of the world out there, I think, doing a good job with really, really small merchants. But Tyro, we've just got recent data from them, still winning, what, 20%? Is that the right number of what is being shed from the banks? And that has been a pretty consistent number over a period of time. And they've got really strong market leadership in particular verticals in that health space in particular. And whatever they're doing, it's been working for a very long period of time here. This business has been around for more than 20 years and has grown to a point. And I think on the point of quality, you have been investing a huge amount of money in growth here as well. They have overspent, in my opinion. You're going to see that come through as profits in the near term. But it takes money to acquire all of those customers. And that, I think, puts them in a good place because they have the market share that they have already there today.
Hey, Shev, versus the other stocks in your portfolio, would this be a higher likelihood of being taken over or not so much?
There's the potential for that, but there's also the potential for that in a lot of other stocks in the portfolio at the moment. So difficult to say comparatively speaking.
There are a bunch of global players that it would make perfect sense for, but it is a competitive market already here. They've had takeover approaches, one from Westpac and one from private equity firm Potentia, but didn't come to anything. So we'll see on that front. Quick one says, will the FISF with the international fund also be moving to Automic? So for people that don't know, our Australian fund has recently changed registry across to Automic. Well, yes, we are trying to get the whole business onto one platform. You should get more news about that soon, and it will be subject to a unit holder vote. But our ambition here is to get all of our investors having one login to one system where both funds will sit. And if you want to change your email address or change your address, you do it in the one place. And our work suggests that Automic is the best registry in the markets in terms of accessibility and usability. So it is our plan to end up with the whole business on the one consistent platform here, but there's a bit of work to be done behind the scenes first. What are the chances of FOR going to an open-ended fund? Do I think most investors are supportive of this? Look, you can assume we wouldn't have made the announcement that we made if we hadn't received some indications of support from some people, but we have been very restricted in who we could talk to. Since we made that announcement, there are definitely some people that like the structure as it is and like buying the fund at a very big discount, but I'd say it has been overwhelmingly supportive of moving back towards something that gives people liquidity at an appropriate price. It's all subject to a unit holder vote, though. It's all subject to the RE agreeing that it's in the interest of unit holders. So there is a lot that needs to happen there, but I'd say so far the support has been positive towards that. Gareth, UK was mentioned as relatively cheap. Any other markets in which you think present opportunities, e.g. Japan, China, or some EM markets?
Being emerging markets there for anyone that misses the lingo. Excuse me, UK is definitely towards the top of the list. It is an unusually cheap developed market. We are certainly seeing some of that in Europe as well. Not necessarily in the big, well-covered parts of the market for the most part. But yeah, in smaller caps, for example, cyclical stocks, we are seeing that in continental Europe as well. And Japan is also becoming an increasing area of focus for us. So we own Sony over there at the moment, but we are looking at smaller stocks. There is quite a push there from the top, from government and from the exchanges to make stock investing to increase transparency, to increase focus on shareholder returns across the whole sector. A few people have written about that recently. James Montier, GMO, Grantham, Grantham Mayo Van Otterloo is the name of the firm. But several other people looking at that. We have some smaller things there that we've been looking at that are quite interesting. Broader emerging markets, no, not really. Hasn't been an area of focus yet.
I would say some of the cheap themes we're seeing that maybe apply particularly to the UK market are also global. Yeah, you and I have been spending a lot of time on financials recently. It's a sector that's pretty consistently priced across all of Europe, and I think even the big banks in the US very, very, very sensible prices. And I think we're, again, back to my previous comments about capital cycle, we are now in a world where you earn a decent return on capital, and I think that sector is particularly interesting. Harvey and I are off to Japan a couple of weeks' time on the way back from a trip to the US, and have a bunch of company meetings lined up over there. If we've learnt one thing over the past 10 years of running this fund, it's that some of those places where you don't have the cultural familiarity can be very difficult as an investor. But I think the opportunity, like you said, in Japan is that it is moving fairly rapidly towards a more Western way of running businesses. But I think there are a lot of opportunities in places that we know and understand well, and that small cap space in the US, has been punished as hard as a lot of the stuff we've seen in Europe and the UK. So I don't feel any need yet to be doing anything out of the ordinary or unfamiliar. And I think even within our own portfolio, the number one priority is getting our weightings right. Question says there's been no distribution in FISA for the past 2 years. Do you think there will be one at the end of this year? Look, what you should expect is that over the medium term, fund performance will translate to fund distributions. The reason that there hasn't been one over the past couple of years is because 2021 was a huge year of returns and distributions, and the subsequent 2 years gave back some of that return, and that's why there haven't been distributions. We didn't have a lot of realized tax losses left at the end of last financial year. We've had the Blanco takeover go through, so it's, I would say at the moment, possible to likely that there will be a distribution at the end of the year. We've had a lot of questions about it. There is nothing stopping us actually having a distribution policy on this fund like we have on the Australian fund, where we pay distributions, some distributions, irrespective of what the returns are. And we are giving consideration to that. I do think it's really, really important that people see this product as a capital growth product, and in that capital growth part of their portfolio. I understand that people do need cash from the investment over time, but in both of our products, the actual returns are going to be lumpy. You get, in that international fund, the return has been 11 or 12% per annum over a long period of time. It's been substantially in excess of cash and other income investments, but it comes in a lumpy format. And irrespective of what we do on the distribution, I think it's important that people think about the investment in that context. Question for both of you. What will be the catalyst for small cap outperformance in your opinion?
want to
I'm
start
happy
off?
to go first. I mean, the obvious one here is takeovers, right? We've seen a fair bit of that. If the stock price gets too pessimistic, you will attract bidders from the private equity world, from the trade world, and we're seeing more and more of that as that small cap sector has gotten cheaper. I think just generally that point that we've made a few times over the last 6 or 12 months is that small caps tend to underperform into an official recession, and then they lead the charge out of that. And that may be what happens here too. I mean, I've seen some dramatic periods of small cap underperformance over the past 20 or 30 years. Value ultimately shines through, and these stocks get re-rated.
I don't think a lot to add from the Australian perspective, but you've seen the number of M&A potential and actually completed in our portfolio. There's a lot more than that in the market as a whole. Like businesses that are smaller relative to larger have seen their discounts widen, and that has led to that rush of M&A. And eventually we will start to see more allocation into this space, more fund flow in, and as a result, we'll see more funds deployed into firstly the larger of the smaller caps, and subsequently into the smaller ones as well.
And look, my comment from before as well was my expectation is that we can deliver investors returns without indexes recovering massively from here. Stocks are cheap. We've seen across both funds, the businesses that get it right, deliver profits, deliver growth, they are still seeing that reflected in share prices. Gentrack's up more than 100, must be getting up closer to 200% over the past couple of years, Alex, in that Australian fund, because it is delivering great results. So our job is to deliver you returns. Obviously, if everything gets wiped out again and we're down another 20%, that is going to impact the prices of everything that we own. But it is a really good market for us to be delivering you returns, I think, even without a massive recovery in small cap indexes. And if we get that massive recovery, it's a huge boost to short-term returns, and it makes things more difficult from the perspective of generating future returns from that point in time. So this is quite a nice market, I think, for us, and I'm not pessimistic at all about delivering returns, even if the index doesn't bridge that gap to large cap stocks. This reads a bit like a Dorothy Dixer. Companies that had historically are cash burning but growing fast and have had to pivot to profitability. Do you find these management teams find this change in mindset quite difficult?
I mean, I can speak to some of the Australian ones. It's been something that a lot of them have been forced into by the lack of availability of capital that they'd previously had a lot of access to. I think some of the better management teams have not found it particularly difficult because they understand what parts of their business were potentially where they were investing for the very long term, that they're now winding back. Sometimes it's new management teams that are coming in and seeing that and winding back excess spending. I think actually the more interesting part is, we talk about this internally a fair bit, there's a first phase where businesses that were burning cash go back to cash flow neutral. And then subsequent to that, there is a second phase of what that business starts to focus on. So some businesses are saying, well, any of the incremental gross profit we get above that break-even point, we will reinvest into further growth initiatives. And some are saying, well, we're not going to do that. In fact, we're going to allow more and more of that cash to drop through to free cash flow. Disproportionately in the Australian fund, our investments have been and will continue to be in businesses that are choosing the latter path, where more and more of that incremental cash flow is dropping through to free cash rather than being spent on growth initiatives.
Yeah, and I would say the correlation over the past 3 years between the spend and the growth has not been as high as you might expect it to be. We had PointsBet out this morning saying they're acquiring as many customers as they were last year, despite spending 30% less on marketing spend. So I actually think for a lot of these businesses, they can get to profitability and they can actually realize that profit itself can be a tool with which you can grow your business, and the two things are not they were only, I think the past 3 years, there was so much cheap money being thrown around that people didn't need to worry about it. But a lot of businesses that I've seen in my life were profitable at small scale and profitable at big scale as well. Just on that topic, there's a question here about the Whisper capital raise. We own Whisper in our Australian fund. Yes, we did participate in that. You'll see a substantial holder notice over the next couple of days that will explain the details. I think that is a good example of a founder and CEO that had grown a business to a certain size that maybe doesn't have the right skill set for running a larger listed ASX company. Jeremy Wells, the founder, is going to stay involved in that business, but has announced that he's stepping back into more of a strategy role, and they're looking for a CEO to run the company. And I think that's actually quite common in a business's life, that there are different types of people needed to run a company at different points in time. Look, I didn't want this to run too long. It's been 45 minutes already, so we might just wrap it up there. We've got a few more questions on here. We'll either deal with them at the next quarterly or send you an email if they are more timely than that. Thank you for tuning in today, everyone, and we'll catch you again soon.